So, if you're in a finance program, you've probably spent a ton of time on behavioral finance, right? Looking at how an individual's own psychology, their own biases, can make them do some pretty irrational things with their money. But what happens when we zoom out? What if the biggest forces shaking up the market aren't just inside our heads, but are actually happening between us? That is the whole idea behind social finance. It's basically arguing that behavioral finance is due for a big upgrade. You could call it version 2.0.
And if you want to see why this matters so much, you don't have to look any further than the whole GameStop saga. I mean, it was wild, right? You had this struggling video game store, and its stock price just explodes. And it wasn't because of a brilliant new business plan. No, it was driven by a massive, coordinated movement on social media. Your classic financial models, the ones that focus on fundamentals or even individual irrationality, they just couldn't make sense of it. It was a social event, plain and simple. And it shows us exactly why we need a new way of thinking to understand the markets we live in today.
So, here's the most important distinction to get straight. Think of the old school behavioral finance, what we're calling 1.0, as putting a single investor under a microscope. It was all about their internal world, their overconfidence, their fear of losing money. But social finance, our 2.0, flips the camera around. It focuses outward. It's all about how our interactions with each other, with our friends, our communities, even total strangers on Reddit, how all of that together actually shapes the entire market.
All right, so first up, let's talk about something that's kind of invisible but incredibly powerful, our shared beliefs and values. You can think of these as the unwritten rules that guide all of us, a lot of the time without us even noticing. And as it turns out, they have a huge say in the financial choices we make.
A social norm, it's basically just a pattern of behavior that everyone in a group kind of agrees on and sticks with over time. Think about attitudes towards gambling, for instance, or on the other side, social responsibility. These beliefs, when they're held by a whole community, can create these powerful currents that pull entire populations towards certain kinds of risks and investments. And this isn't just theory. We can actually see it in the data. So check this out. A 2009 study asked a really clever question. Do people who like to play the lottery also tend to buy what you might call lottery-like stocks? The super high-risk, high-reward penny stocks. And the answer was a resounding yes. The exact same demographic factors that predicted who was buying lottery tickets also predicted who was investing in these super speculative stocks. That social norm around gambling was literally mirrored in the stock market. Okay, let's push this idea even further, because this is where it gets really interesting. Can something as personal, as abstract as a community's moral framework, could that actually have a real measurable effect on how a corporation is run? To find out, some researchers decided to look at religiosity across the United States. And the results were kind of stunning. They found that companies headquartered in U.S. counties with higher levels of religiosity were, more conservative. They took on less risk, which you could see in their stock returns and their return on assets. They also invested less in things like R&D. So what this suggests is that the moral compass of a community seems to be directly correlated with the risk appetite of the companies that operate there. Crazy, right? So if these big, broad cultural norms can have such a big impact, what about our direct personal relationships? The people we actually know? In this next section, we're going to see just how much who you know can affect where information and money ends up flowing. A classic example we all know is the so-called old boys club, right? Those powerful networks that get built at elite universities. But is that advantage real? Is there a measurable financial edge to being in the club, or is it just about having fancy cocktail parties? Well, the evidence is pretty hard to argue with. Studies show that mutual fund managers are way more likely to invest heavily in companies where they went to the same school as a top executive. And guess what? Those investments perform better. They generate superior returns. It's the same for financial analysts. They give more accurate earnings forecasts for companies that are run by their fellow alum. These school ties create a real, tangible information advantage. But hey, it's not just about elite schools. What about our regular, everyday friendships? Now, in the digital age, we can actually measure this stuff. One really fascinating study used Facebook data to see if your friends' experiences in the housing market could actually influence your own decision to buy a house.
And the result is pretty powerful. What the researchers found was that for every 1% increase in the home price appreciation your friends experienced, your own probability of becoming a homeowner goes up by 0.6% that year. It's like when you see your friends doing well in the housing market, it makes you more optimistic and more likely to jump in yourself. It's social influence in real time.
Okay, so we've covered culture, we've covered personal networks. Now let's get even broader and think about physical space itself. Because as it turns out, geography and the roads and rails that connect us can create some really powerful financial networks. To test this, researchers found the perfect natural experiment, the rollout of China's high-speed rail network. This was a massive infrastructure project that dramatically cut the time and money it took to travel between big cities. It effectively made the country smaller. So the question was, would this new physical connection also create a new financial one? And the answer was yes, in this really clear three-step process. First, the high-speed rail physically connected the cities, obviously. Second, investor behavior actually changed. You could see a measurable spike in trading and even just online searches for companies that were located in these newly connected cities. And third, all that attention led to better market outcomes. The companies in those cities saw their valuations go up, their liquidity improve, and their stock turnover increase. A piece of technology literally created a new financial network that changed asset prices.
All right, we've established that these social forces are real and they're powerful. So now let's bring it all together and see how this applies to the modern world of investing, which, as we all know, is defined by incredible speed and social media. This right here is the key theory you need to understand: social transmission bias. Now, it sounds a little academic, but the idea is actually super simple. It's just the fact that when information passes from person to person through a network, it doesn't stay the same. It gets tweaked, it gets simplified, it gets exaggerated, it gets changed in a systematic way. Seriously, just think of a giant global game of telephone, but with stock tips. Okay, now let's look back at GameStop with this idea in mind. Suddenly it all clicks, doesn't it? The original idea of a short squeeze, which is pretty complex, got passed around through social media, and along the way it got simplified into this powerful, really emotional story. Us versus the hedge funds, to the moon, diamond hands. The idea itself was modified as it spread, which amplified its power and led to that massive herding behavior we all watched happen. But here's the million-dollar question. Does this kind of herding behavior actually make people money? Well, this chart tells a pretty grim story. It shows that during the biggest herding events on the Robinhood platform, the top half of 1%, the average return for those stocks over the next 20 days was a staggering negative 4.7%. Basically, buying driven by social media hype often ends up being a forecast for some pretty significant losses. So what's the bottom line here? What are the big things to take away from all this? First, social finance is the essential next step after individual psychology. It brings group dynamics into the picture. Second, everything from your culture and your friendships to the train tracks connecting cities can shape financial markets. And finally, these social forces are incredibly powerful, and they can create these feedback loops that make booms bigger and busts even worse, with very real consequences for all of us. And all of this leaves us with one last, really crucial question to think about. In a world that is more connected than ever, where information and misinformation can spread around the globe in an instant, we have to ask ourselves, what is the true price of all this social influence? What's the cost, and what's the benefit? Honestly, figuring that out is probably the central challenge for the next generation of finance.